FOMC meeting, the US Feds have decided not to hike interest rates, Suyash, this time around.
Yes, Shweta. So the Fed has maintained the key rates, for the second, I think, for the second straight policy meet. And I mean, there are two major takeaways that we can get from the policy outcome. Now, the Fed said that it will keep interest rates higher for longer. Now, Mr. Powell indicated that there will be about 2 rate cuts heading into 2024. Now earlier they had indicated that there will be about 4 rate cuts. So that will be a major negative for the markets as investors were banking on monetary easing heading into 2024. Now the second thing is that Fed also said that it could consider hiking interest rates one more time when November rolls around. Now this is again because inflation continues to remain a pain point for the Fed, and now the problem is there was expectation that Fed may consider hiking rates, but it seemed like a distant possibility as only about 30 to 40% analysts were expecting that. Now it seems that that could be the way forward, that Fed may hike interest when November rolls around. So perhaps a negative for the market, Shweta.
All right, negative there for the markets, and the markets of course reacting negatively to that news. Was a rate, I think a status quo, Sudip, it was expected, wasn't it? That is what analysts, a lot of them we've spoken to here on News9, have also said over and over again. No rate hike perhaps this time around, but near future and how inflation pans out to be, whether it comes within US Fed's comfort zone of 2%, will determine the future rate hike cycle.
Absolutely right. But look, I think as Suyash was mentioning, I think the commentary of the Fed chair and a little bit of an aggressive stance as far as rates are concerned, that did make the market a bit worried. Expectation was that the body language and the commentary will be also a little subdued. There won't be any aggression as far as interest rates are concerned. But I think the commentary of the Fed chair is what kind of rocked the market. And very clearly, I think there will be more rate hikes. And the rate reduction cycle, rate reduction probably gets pushed back a bit more than what was originally expected. That did cause the damage as far as the Nasdaq is concerned, and even other markets.
So what's your assessment of this higher rates for longer narrative? Now this will definitely be a negative for markets, but how do you think it will impact emerging markets, especially India?
Well, Suyash, I think the way I look at it, FIIs, FPIs have been investing in India, and they will continue to invest. Of course, there will be volatility, as is always with these kind of flows. But if you look at a slightly medium to long-term view, what is happening globally is that emerging markets, funds have started attracting a lower amount of incremental flows, and that's predominantly has got to do with what's happening in China, whereas India dedicated funds have been attracting higher incremental flows. I think this trend is going to continue, and I think if one goes to interpret this trend, it's very clear that India will continue to attract more and more money as time goes by. Yes, there is definitely a fear and a rush to withdraw funds out of China, and some of that money will definitely find their way into India. That will be some of the funds will be long term there, and some will be short term funds as well. So volatility will be there, but India will continue to attract FIIs flows as we go along in this fiscal as well as the next fiscal. That is our reading. We also believe that Indian corporate performance has improved significantly over the last 1.5 years, and that does put India in a slightly better position vis-a-vis many other emerging markets. Also, by and large, the strategy of global corporates of China plus one is helping India in manufacturing and Indian trade, and this will continue. Now, this again indirectly will work towards attracting incremental business for Indian corporates and more inflow into Indian capital markets. So, if we put all this together in the mix and keep that and weigh that along with the interest rate scenario, and interest rates may not be coming down as soon as we were expecting. I think on the balance, we believe that India will continue to attract money, And as is very clear, with India dedicated funds getting more and more incremental inflows, I think that trend will continue in spite of what is happening as far as interest rates are concerned. One last point I would like to make is that there was a lot of question marks over soft landing, and even now there are, as far as US economy is concerned. But if we look at the indicators, if we look at how the US Fed and the US economy is being managed, I think the soft landing is a distinct possibility. And if that happens, I think we need not worry about US liquidity and US flows.
Mr. Bandyopadhyay, I just have another question. Now, do you think that there is a lack of coherence between fiscal policy and monetary policy? Because at a time when Fed is struggling to, keep inflation under control, we have seen that, the fiscal spend has climbed to about 3% of the GDP. So, do you see that there is some bit of, the coherence is lacking between the fiscal and the monetary policy?
Well, that's unfortunately what you get when you have a democracy. US is also heading towards an election. And as we know, the compulsions in an election year are different as far as the political establishment and the fiscal policy is concerned. I think monetary policy has to balance that out, and that's what the Fed has been doing. I don't think we need to get too perturbed with that because US has strong checks and balances. And as we have been reading that there may be a US government, unfortunate, but US government shut down because the allocations may not get approved. So all that confusion, all that drama will probably get played out over the next 9 to 12 months because it's an election season and because the political tension is equally high in US. So the Fed will have to keep doing the balancing act and trying to contain the challenges which fiscal policy poses from time to time during the next 12 months.
All right, and since we were talking about FIIs, I also want to briefly understand from you, Sudip. There is some buying interest there as far as FIIs is concerned in the past 1 month. Do you see, a larger investment coming into India in the capitals market in the near course? Because let's admit it, the interest has been subdued in the past couple of quarters. Is that going to reflect in the future as well as Indian markets remain volatile?
Well, I think if you look at a medium to long term, I think we will continue to attract FII inflows into India. There's absolutely no doubt in my mind about that. Short term, there are a lot of factors as we have been discussing, US Fed, inflation, interest rates, and also Indian corporate performances. So there are a whole lot of things which in fact influence FII decision on a short-term time frame. But there are other factors also. If you look at the recent data, which indicates a subdued FII inflow, net inflow, because a lot of old transactions which the foreign investors were sitting on are being unwound and profits are being booked. We have seen a flurry of PE exits from multiple companies. We have seen a lot of FIIs unwinding their old positions. Now, these definitely happen, and it's good for the market to happen because the overhang on the counters, because we know that sometime they are going to exit, and that's happening. But the interesting part is part of that is also being absorbed by new funds, new foreign funds, part by domestic investors. So it's an interplay of these things which will continue, and that's a very good sign for Indian capital market. But fundamentally, medium, long term, definitely a lot of incremental inflows will keep coming to India.
Okay. I also briefly want to touch on inflation, since that remains the underlying theme here in India as well as in the US. Crude prices are hovering around $96 to $97 a barrel. That, of course, will impact inflation in a big way in the US, at least to begin with.
Absolutely right. Even in India, why India is definitely, this is the one single largest item which does affect Government of India's budget. And crude at 95, 96 is definitely not a good development for Indian market, Indian capital market, and Indian economy as well. So that is a matter of concern, and we have to be cognizant of that challenge. Now, the inflation has multiple other components, and we have been struggling in India with food inflation, food price inflation. And that's one thing which needs to come down. And probably with a good monsoon and expectation of a good Rabi crop arrival, I think food inflation should start coming down. We have started seeing initial signs of food inflation coming down, and if that gets played out, probably it will get balanced out. Unfortunately, the oil prices have gone up, so we won't see a drastic reduction in overall inflation numbers, but probably it will get balanced out with food inflation coming down and oil prices going up. I think that's what the challenge is. Also, remember that in an election year, election season, oil price increase in the global markets may not and normally are not passed down the line, and the oil prices may not go up in the economy. The loss may get absorbed by the in different ratio by the marketing, producing, and distribution companies, and probably that will lead to less pressure on inflation, domestic inflation. In any case, we must remember that commodity prices overall have not moved up. So it's only the oil which is kind of a joker in the pack, which is going to create trouble. Rest of the components of WPI or CPI are and should come under control very soon.
Okay, and election year not just in the US but also in India. Karthik Malhotra joining us here in the studio. Another interesting story that we are picking up is, by the way, of